John, the last time you talked to us, I think, was May 24th, and you told us at that point you should be investing like a lion, buying everything. Looks like a good call given where we've come, but what do you say now?
Well, when we talked, we wanted to avoid the weak ones, which was sort of the lion metaphor of, trying to kill the weak ones. And we think the market's rallying here, but we still have some concerns.
What are your concerns?
Well, number one is we think the Fed's too tight here. They're too tight by about 50 basis points. The 3-month Treasury note yield is higher than everything on the yield curve except for the 30-year, which seems a little odd to us. Number two is there's some momentum divergences whereby the S&P is hanging up, but its internal momentum is deteriorating. That has to be resolved. Number three is gold is building here, and usually that builds because there's something afoot. And so those things put together, besides what's going on with respect to trade and all that sort of stuff, tells us we think that it's better here to be cautious than to be aggressive.
When you say that the Fed is too tight here by about 50 basis points, that means you expect them to cut twice in the near future?
I'm going to leave that to the economists. We thought rates would come down, mostly because rates across the G7 spectrum were coming down. There was no way they were going to go up here if they were coming down there.
Right, and yields, the market has been determining rates. Forget about what the Fed says
exactly.
at this point.
So we think they're going to raise by 50. We don't know how it's going to happen, but that is what we think has to happen. And we think yields are going to continue to stay low. And I'm not certain that that's an economic effect or just a bond market effect. I know that that may be a distinction without a difference, but we think the market has some issues here that it has to work through.
There was a technical analyst at Bank of America Merrill Lynch yesterday who looked at the performance of the FANG names, those 4 stocks, and said that there were serious problems, like a head and shoulders pattern that was setting up, and that spelled problems for the broader market too. Would you agree with that?
I don't like the pattern guess. What we like to say is that the momentum for those items is deteriorating for those items, and we think that they have further to, let's say, consolidate or work lower before the market puts in a good oversold reading.
We are now looking at crude oil in a bear market, down more than 20% from the highs that I think were set back in April. What do you think when you look at that chart?
So our call on crude was that it was going to go to 50, and we don't think it's a stretch to think it could get back to the late 2018 lows, which was around $42. If you really took a look at a long-term chart for crude, you'd see it's really a distribution that is very volatile and looks like it's coming in further. You can see the chart there, and just look to the bottom of that trend line. The bottom of that trend line would be cataclysmic because it would probably mean other things are going on, which none of us have any idea about, me included. But the low from the late 2018 period is about $42. We think that's in the ballpark for estimates.
When you say other things going on, are you referring to a lack of demand for oil
global
prices?
growth may really be coming off a cliff if that's going to get back down to the bottom of that trend line.
Kevin, what do you think when you hear all this?
I'm really intrigued by your comments about gold because to have, and I own a 5% weighting in gold, it's been very dead money.
Very dead.
El morte,
yeah,
as I like to say. So to have you say gold's interesting when oil's collapsing and the 10-year could go below 2, what is going to be the stimulus when usually inflation is the only thing that makes gold move?
Well, not necessarily. There have been periods where gold has worked and inflation has been high. There's been periods when gold has worked and there has been no inflation. Perhaps we would go through another round of QE. Perhaps there's some sort of systemic failure. I'm not predicting. I'm just saying these are.
You need a
catalyst to get it through. But if it gets through 1375, 1400, our estimate is that gold in the next cycle will make a new all-time high.
Well, gee, less music to my ears, but boy, we've been waiting a whole long time.
6.5 years, it's done nothing. So you're right, it has been El Norte since for 6.5 years.
But wait a second, Kevin, it's music to your ears, but it's only 5% of your portfolio. If there's a cataclysmic event that happens, what happens to 95%?
What I've learned is if it takes the end of the world to make gold move, you're only going to get one good trade out of that. So I leave it at 5% because it's an old-timer's way of saying I'm going to hedge inflation, but it's not working. And, then there was the Bitcoin story about that working instead of gold. That's not working either. So, it's very interesting to see a commodity that's been around for 2,000 years and always performed well have this long period of, I don't know who I am anymore. It's lost its identity.
Well, it also had a long period of that prior to 2001 when it first started to move at $280. So gold has gone through sort of sleepwalking periods, and then when it's emerged, I don't know, rising like the phoenix, so to speak, it really had a tremendous move. It went from $280 to $1,200, and it's gone sideways now for 6 years. So if it gets through 1375, 1400, the likelihood, at least on our work, that it can get to a new all-time high is pretty darn good, given its history.